those live trades and what we're looking at and what we look for in trends when we're trading. So all the things that we look at. So I really want to give you a really good insight. And I tell you, I found something unusual today. I was just clearing out some things, and I found the very first document we had with our law firm when we set up the hedge fund. That's going back to 2007, so it's subsequent to setting up the fund. And we use Simmons & Simmons as the lawyers to set that up. And I found the documents from PricewaterhouseCoopers as well. And you can see there, we were located in the Cayman Islands. It's a British company, but the funds were domiciled in the Caymans. And that's the UK base. And the very first set of offices we had for the fund going all that way back. Anyway, so that only proves to you that I'm old. So in the last 14, 15 years since setting up the fund, I'm going to give you all of that information, know-how in this webinar. More importantly, is because you're retail clients, I'm going to give you a copy of this to download. And it's my Financial Times published book, Lessons in Trading Strategy from the World's Leading Traders, The Mind of a Trader. So you're going to get all of that. Big, thick international bestseller for being on this webinar. But equally importantly, or possibly even more importantly, what I'm going to do is give you the insights of some of the world's leading traders as well. Trading's been really good for me. It's allowed me to meet some very interesting people, and you can see them on screen there. But it's also provided the things that the reason most people are on this webinar is that they want to trade for what I call the three Fs. Fulfillment. They're going to be self-employed, so it's fulfilling. They get to keep all their money, so it's fulfilling. Funds, money, of course, is the reason why people want to know about trading. And fun. And if you don't enjoy it, you won't succeed at it, and there's no point trying to bothering to do it. So it's a case of all of those things, and all of those reasons is the reason why people are in it. Now, the problems we're going to solve. So this is our plan of action for today and the webinar, and the problems we're going to solve are these. Okay, first I'm going to tell you the problems you need to overcome. I'm going to try and do that in about 10 minutes flat. Then the professional solutions you can copy. In other words, what do the world's leading traders do? How can you copy that? What do I do as a hedge fund manager? But more importantly, what do the traders, when I wanted to get into trading, what lessons in trading strategy did those world's leading traders teach me? Okay, so I'm going to share that with you straight after, and then we're going to go through a business plan so you can work out, well, is all this trading worth it anyway for you? And then I'm going to give you the rules to my trading strategy built on the problems that we need solving and the best practice and the business plan, so you can understand as it builds upon each thing, think, oh, right, okay, that's why his strategy is the way it is, and that strategy is based on what the best traders in the world have taught. So it's for all those reasons. And then I'll tell you right at the end, in the last 10 minutes, and you don't have to stay for that, but if you don't want, what my hedge fund is doing in the fintech space, the financial technology space, the venture capital funds that we're speaking to and plans that we have. And we'll do the Q&A, give you the free book and all the rest of it after that as well. So there we go. That's that. Quick, important piece of information. Please don't copy the slides. Please, please, please have a phone ready so you can take photos of any of the slides. Now, the reason I say this is in the past, one or two people complain, oh, you went too quickly. And, you know, there's a lot of information on the screen. I can't wait for you to sort of write every single word down. So please have a phone ready to take photos and images of any of the screens that you like the look of. Yeah, everyone's got one of those phones, and it takes less than a second to do it. So please do that. Also, everything that I'm telling you is not financial advice, for the simple reason I don't know who you are or what your situation is. So Steve, Vic, Brian, welcome, Peter, Carlos, Rakesh, I don't know your personal situation, so I can't give you individual financial advice over a webinar where I'm speaking to a broad audience. So it's to educate you on what the best practices is in trading and investing. Karen, John, Tarek, Alfredo, Alan, Gren, everyone else, welcome, welcome, welcome. And as I said, the message, really the key issue is to all of you, please know that it's not individual financial advice. Now, one other checklist. As David Kite, one of the world's leading traders that was in that book, and like I said, I'm not plugging the book, so you're going to get a free download of it at the end of the webinar. What he said is, we're here to make money. And I like that, because as a Brit, you don't often say that. You know, it's sort of crass to talk about making money. So what I'm going to show you in a second, whether it's the S&P 500, the FTSE, PayPal, Amazon, all the rest of it, it's actually, ultimately, it's about that. Therefore, please follow these 6 rules. Close the doors, please make sure it's quiet, focus on this, grab some water, it'll help you concentrate, and grab a notepad. Please grab a notepad, because I'm going to tell you to write certain things down, okay? And you're not going to be able to get them elsewhere, and then you're going to be scrambling for stuff. So please, please, please do that. These are the problems we want solved. All right, so the first part of the webinar, And I want to try and do this in that part, the problems needing solving in 10 minutes flat. And the problems are these, okay? Is trading worth the effort? So we're going to need a business plan in this webinar. How can we do it simply? There's a million ways in which you can trade, which is rather complicated. You as retail clients, there's no point telling you about the very complicated ways with supercomputers. We don't even use those complicated ways, okay? We want to keep it simple. We want to have an idea of the returns and the timelines and the skills so you can decide whether it's for you or not. Remember the 3 Fs and write those down: fun, fulfillment, funds. That's the reason we're doing it. And the target that I try and set new students who join my firm, for instance, fresh out of university, is I say to them, look, I want to first of all teach you how to target 500 a month. You guys say, why not? Why are you giving that to them? Why aren't you telling them to target 5 million a month? Well, imagine the capital you'd have to give them for them to target larger sums, and they're newbies. So I'd be stupid to do that, wouldn't I? So I say to them, I want them to target 500 a month. Some months you might get more, some months you get less. Unless you're consistently getting around that figure, you can't move to then try and target more returns. And the difference between rich and poor for most people is 500 plus or minus. It's not 5 million, it's not 50 million. And if you can learn the skills to make 500, you've got the skills to make 1,000. If you can make 1,000, you can make 2,000. So we want to start small, actually with a demo account and no cash down, okay? Because you're learning a skill, just like when you're learning to drive, okay? You don't want to be going out in a Ferrari on the motorway. You're just going to crash and die, and you're going to think, oh my God, this driving business will never catch on, okay? We're going to go through the rules of leading traders and the proven rules. Like I said, it's been published and verified, and that's just one of the books I've written. There's many more. Don't worry about all the books. It's not a plug for the books. Trust me, you get so little in royalties from the Financial Times, rich though they are as a publisher, that it's just really a case of sharing that information with you. I'm going to give you a business plan. So like I said, you know a process, what to do, how much you might make, so you can be targeted, focused, and get on with it. And it removes your fear of missing out. You know, you might at the end of the webinar say, you know what, this trading lark, it's not for me. Great, that's wonderful, okay? And I don't want you to be a screen slave, so that's another problem we're going to solve. And you don't want confusion, so I'm going to give you a no confusion guarantee. Nobody should leave this webinar confused at any point. Otherwise, I'll stay on the Q&A until I can remove all and any confusion that you might have. I get lovely messages like this when I do these webinars. And this is one from a while back. You are a genius. That caught my attention. You better believe it did. Let me tell you something else from a lady called Betty. I'm not a genius. I'm you. I'm a retail client originally. Then I moved on to setting up my own fund, and I'll tell you a bit about that journey later on. And that's been in the last 15 years. But before that, when I was at school, no silver spoon in my mouth, didn't come from a rich family, grew up in Armley and Leeds, I was a retail client. Okay, so built that journey up. And what was in the books and what's in the Financial Times columns that I wrote, the Diary of an Internet Trader columns, and what was in my Bloomberg TV show is just teaching all of that stuff that I know. Okay, it was as simple as that. I started at a young age because I just got addicted to the markets from when I was about 12. And I gave up being a barrister in order to do it, right? It's as simple as that. What I am good at, and what I do think I'm a little bit of a genius at, is training up people. And I have to be, because in my fund, we can't afford to hire, executives on 10 million a year. We can't hire the Ronaldo of the hedge fund industry because, well, it would cost too much money. And why should I anyway hire them? What I'm good at is training up employees, and I'm going to teach you the same things I teach them when they join my firm. People like Naomi Westall, who left university with an English degree, joined my firm at the age of 21, worked for me for 2 years as my assistant, and now manages billions. That is one thing I'm good at, is training up people, because that's one thing as an employer I have to be good at. If you're rubbish at doing that as an employer, then you're rubbish. So I'm just going to teach you the same things that I teach them. Let's start off, first of all, with what's happening in the markets. The reason more people are getting interested in trading more recently, of course, it's what's happening with the markets. They're at all-time highs, and that's not just in the US, but we're getting this massive rally in Europe as well. And so people are thinking, well, if it's going to pull back, I need to be able to be more nimble. I can't just buy and hold forever. I need to be getting in and out. And this webinar very much is about trading, of course. So that means people are saying, well, wait a minute, I don't necessarily want to hold. Let's look at the FTSE. Okay, so this was from the webinar I gave a couple of days ago. It's the same chart. Okay, and I showed it then. And the down arrow, whenever I show this, means selling. Okay, now this data, all these charts, all this data, all of these products you see, that's all free information out there on the internet, available from many brokers. So it's broker independent. That's always important. You don't want anybody who's tied to a broker, because they're getting kickbacks, and that compromises their independence. So a lot of software companies out there, they're trying to flog you their own broker because they get a kickback, which means they want you to go bust because they get a kickback on how quickly you lose your money. So many brokers offer this kind of platform, which is free data, free charts. Great. I don't want you to pay for anything. Whenever I show a red arrow, that means we had a short trigger, i.e. to go short. Green means long. Now, that short in the FTSE 100 worked great. If you're on Wednesday's webinar, you saw all of this and you thought, wow, wonderful. We're currently long on it now. It's a bit of a bounce back. It probably might not last too long, but whatever. So I'm going to explain in this webinar what that red dotted line means. It's not a profit target. It's where we add to our winning positions, because winners add to winners. You can write that down. Winners add to winners. I'll explain that in more detail. My point is this. People are getting more interested in trading at the moment because they're seeing these sharp moves down, and they don't just want to sit there and take the pain. And they're thinking, well, hang on, if from the 6th of September to the 9th in 3 days it falls, I could make that money on a trade, couldn't I? Yeah. And our critical thing here, and you can see these other positions, is to make sure any trades which don't work out, because we don't have a crystal ball and we're not right 100% of the time, or even close to that, okay, any losing trades like that red arrow there, or that green one, or that green one, they're short in duration, they're small in size. Short in duration, small in size. Write that down. Any good strategy, and strategy, I'll give you one of our 10 in the hedge fund at the end of this, not because you're going to go out and set up a fund, but because you could use the best practice. Any good strategy should be small in size, short in duration with any losses. So you see it there. And you might say, wait a minute, hang on, Alpesh. That's 1, 2, 3, 4, 5 trades there, and 3 of them are losing. The minority 2 are winning. And I'd say to you, yeah, it's how much you make. Look at that, big win. That's all right. We'll see what happens. But and you lost next to nothing. That's what happens very often with trading, and that's perfectly fine. You'll see it from one of my mentors. There were 10 people I interviewed for this. What every single one of them said in this was exactly that, and that surprised me, because I thought when I'm going to meet these world's leading traders, these super rich, they knew why I went to see them, because I wanted to make money. And I was a student at the time, and I was writing the book, and the FT said, we'll publish it if you can get interviews with these people, and I got interviews with those people. I was expecting them to say, oh, we make money because we got this secret inside information. Here it is. Surprisingly, what happened is when I looked at the data, not just for them, but for others, and how often they were winning and how often they were right and wrong, they weren't winning that often. What they were doing differently was when they won well, they won big, but most importantly, when they lost very little. So I'm going to show you how we solve that problem of making sure it's not trying to be right all the time and trying to gamble on calling the market every time, but actually that we ensure we're not losing big. Because what you left if you're not losing big, all you're left with is either small losses, small wins, or big wins. It's all that can be left if you're not losing big. And after all, don't forget, when you're looking at this data, you, me, George Soros, the biggest hedge funds, we've only got 2 decisions to make. You're getting the same data they are. You're getting the same information they are. There's only 2 things to look at: when to buy, when to sell. So how come you, me, George Soros, everyone else gets the same data, the same information, the same 2 decisions to make: when to buy, when to sell? Yet private investors, 70% of them are losing money. Okay, because even within those 2 decisions, there's a lot that can go wrong. So in this, we're going to remove those problems. Now, just going back to where we are and why people are getting into trading, and the main problem we want to solve, which is what if the market falls back? Okay, this is a measure of the market capitalization of the US stock market compared to the size of the economy. This suggests it's overvalued. You don't need this. I could give you a million other pieces of data which might suggest it's overvalued. So that then begs the question, well, wait a minute. If it's overvalued, Alpesh, should we not be looking at A, being able to short, and B, doing some short-term trading where we can jump ship and not be handcuffed to a stock as it drags us down and drowns our whole portfolio? So that's the other place trading comes in. Okay, that's the other place trading comes in at that point, which is, oh, okay, market's overvalued. We better learn how to short, i.e. sell high, buy low. Okay, sell high, buy low. That's shorting, because it's still always, profits are always the difference between the buy price and the sell price. Doesn't matter whether you buy first and sell later, or sell first and buy later, right? And I'll explain that as we go on. Another piece of data, you might want to take a photo. You can see why I'd want you to take a photo. I'm not going to read through this and spend half an hour on it. Take a photo. It's another one which is suggesting that we might be overvalued. So all of these reasons, or put another way, all of these reasons, like I said, make sure you got a phone, take a photo of any screens, are suggesting that we're overvalued. We want to learn how to trade and take advantage of any falls and protect ourselves. Of course, there is other data which is, ambiguous, like this: percentage of US stocks trading over 10 times price to sales. Does this mean we've got more room to the upside, or does it mean we might fall? Are we overvalued, undervalued? One thing that's for sure is when we're trading, we're not just looking at stocks. I don't care what I trade in. Now listen to this. When I go to Starbucks and pay for those overpriced coffees, what happens is they don't ask me, did you make your money in indices, crypto, oil, stock, or whatever? What I say to my students is I want you to be scanning 12 instruments, 12 to 20 for 15 minutes a day, placing one quality trade a day. And I will explain those numbers in a moment as well. You can write them down if you want. 12, 15, 1. But I'll explain them as we go along in this webinar and why those numbers and why in a business plan that's ample, because it is the balance between being a screen slave, getting a return, okay, and that's what's important. So what happens with this is I far prefer actually trading currencies than I do stocks for the very simple reason currencies, I can trade on the upside and the downside. And I don't need to try and work out is the market overvalued, undervalued, or whatever. It doesn't matter. So we're going to pick trading strategies based on saving us time, removing confusion by not looking at macroeconomics, by not trying to out-analyze Goldman Sachs and say, oh, I'm going to stand in front of what they might do. I think they might go long on this, or they might buy this stock, or they might short this one. No, we're not going to gamble on which way the market's going. We're going to ride their coattails. And that's how we're going to solve that key problem. Okay, we're going to wait to see what they do and then just copy it. That's a lot safer. So how we do it in our hedge fund, it's how some of the world's biggest hedge funds, I'll show you, do it. They don't try and guess which way the world's going to move. They let the money go in that direction, in that momentum, and then they ride those coattails. I mean, when you see stories like this, no wonder people are getting more interested in trading. And yes, like I said, it doesn't mean that the markets are going to crash, because retail traders, and this is from Bloomberg, retail traders keep coming in and saving our skins each time the markets fall. Again, it suggests with this kind of volatility, we might want to trade the downside, trade the upside. Look, the prices stayed the same, but if you're trading, you made profits on the downside, profit on the upside. That's why people are trading. That's why they're willing to spend a bit more time, okay, to trade, to make that better return than if they were just investing. Don't get me wrong, I invest. Okay, those of you who know me know I'm an investor, but I also trade on the short term to add that extra layer of return. And the reason I said at the start, I want people just targeting $500 a month is if they can do that with a demo account, $500 or £500 a month, that makes the difference between rich and poor in terms of paying down some credit card debt, paying your rent, mortgage, your children's education, or whatever else. We're not going to try and shoot for the moon, because what we've discovered, and in my firm especially, is that when you give people too large a target in too short a time and they don't have the skills, they completely crash and burn. Whereas if you take more time developing those skills, then you can gradually increase the revenue targets. It sounds common sense, doesn't it? Guess what? Most people, they don't realize how obvious that is, and they should be doing it. Again, Morgan Stanley, they think there might be a bit of a pullback, and that's, again, why people want both those skills. You have your investment portfolio, and because you're trading, you're calm if the investment portfolio falls over a couple of days, because you think, well, it's all right, I'm trading anyway. And if your trading doesn't go too well, or a week you can't do it, or 2 weeks you can't do it because you're busy, you think, it's all right, I've got my investment portfolio. And that's why I like both things. Okay, and we're talking very much about trading. Like I said, I know there's big interest in trading at the moment because Business Insider wrote this article, and I love that headline they did. Okay, it tells you that there's a massive interest in trading, and this is why. However, here's a warning. 70%, at least 70%, according to brokerages of retail traders lose money. 70%. So that means 30% are making money. Now, if you're a glass half full person, you're going to go, wow, 30% make money trading. Where do I sign up? Or you're going to say 70% lose money. Forget that. I just want to stick to investing. That's up to you. That's up to your own risk appetite. Okay, certainly I know in my industry at the moment the amount of cash going into hedge funds is phenomenal. We don't ever have retail, no hedge funds allowed to take retail clients, so all of you should know there's no conflict. I don't have any conflict with you and your interest, because we can't take retail money by law. We can't even market to retail clients. It's a criminal offense to do so. Our clients are Aegon, AXA, the pension funds, sovereign wealth funds, high net worth, for instance. Okay. Is there a bubble? I've shown this slide before, and just very quickly at this problem of is there a bubble or isn't there? We want to ride the upside. That white line shows the last 5 years and the NASDAQ, okay, that white line. The blue line shows the 5 years up to the stock bubble of March 2000 when the market crashed. So it suggests that the white line, which is us now, has a long way it could potentially go. Yeah, you could argue either way. My point is, if we're trading anyway, we're not trying to call the market. I do not care. If somebody says to me, oh, is the market going to rally more? I can give an educated guess, but I'm not going to trade off the back of it. I will always trade off that. I will trade off the likely momentum. So you can ask yourself, well, wait a minute, what was the price doing just before that? Well, I don't recognize that pattern. That doesn't look a Japanese this and an Elliott wave that and a Fibonacci that. What made you think it was going to fall? And how come you had so much time before it fell to put the position in and then boom? Okay, so what was it? What setup weakens the market? And then if you get the trigger and somebody starts selling, it all collapses, the straw that breaks the camel's back. What is it? And again, short on whether it's Ethereum or oil, I could not care less, because I am not gambling on the short-term whims of the market. We are riding the coattails of those trends. We're going to be more trend following. There is another reason why people are looking at this as well. So in this first part of the webinar, I'm talking about the problems. It's these reasons they're looking at it. And this was research done from a brokerage. It said a lot of people are losing sleep over their finances. So they're looking at the financial markets. Now, if you do it wrong, you do trading wrong, you're going to lose a hell of a lot more sleep, I'm afraid, if you do it wrong. So do not think trading is going to remove your worries. In fact, the best traders are people who don't have financial stress and financial worries. Don't do it because you're thinking, oh, I need to make a lot of money really quickly. You'll mess it up. Your psychology is all wrong. You need to be able to do it at a point where, no, I'm not doing it to make a shed load of money by tomorrow morning. I'm doing it to learn a skill, and then I'm going to see next step if I've learned that skill and if it's something I can apply to make money. Though it's a three-step, not a one-step process. You know, can I learn the skill? Have I learned it? Can I make money? Not, I'm going to make money by tomorrow morning. Okay, like I said, financials are causing people enough trouble, their financial situation, they're taking sick days off. And this is worrying. Okay, and I'm not saying trading is the answer. What I'm saying is it might make your problems worse if you don't learn the skills properly. So treat this not as a get rich by tomorrow morning, but as, are these skills I'm interested in? Okay, is this something I want to do? And then we'll work out whether you want to do it or not. Like I said, watch to the end. I'm going to give you digital download of that, plus more books on trading, which I think are really good. Plus, I'm going to give you more additional lectures on these things. I'm going to expand on these things, all free. Okay. So like I said, we've discussed the problems. We now want to look at the professional solutions you can copy and a business plan, and then we'll get to the trading strategy. It's as simple as that. So what are the professional solutions? Well, the professional solution, which leads us to the strategy, has to remove these problems. There's 4 types of losing traders. Write this down. And there's 1 type that wins. Okay, so there's only 5 things you can do in the markets, basically, in any trading, right? And that's why 80% of traders, or 70 to 80%, lose money, because they're in one of these 4 losing strategies they're using, and only 20% roughly make money, 20 to 30%, because they're doing the things right. They're doing the things which the hedge funds do. They're doing the things which, when we analyze the data, and we published the data, and we analyzed it, we published it, in my columns in the FT, what we found is they were doing, the retail clients who were profitable were doing the things that the professionals do as well. So what is it? Well, the losing strategies that we're going to remove. So, and this is to explain why our strategy is the way it is. Because if I just give you the strategy rules, you'll say, well, why that? Why that? Why not that? And you won't follow it. You go, no, I don't believe that. Why should I do that? Why should I do this? Now you'll see why. Okay. And put your hands up if this is you, if you've lost money by doing this. What you think to yourself is the price is at 100, so you'll set a target, maybe 200, and that'll be your take profit target. You know, people talk about risk reward. They go, oh, I had a 3 to 1 on that one. Absolute idiots, honestly. And they're usually on social media. Okay, and you'll have a stop loss because you were told by somebody stop losses are good, and they are good. So you'll put a stop loss there. Practice this at home. Don't do it with real money. Just monitor the markets. Do 100 of these, and this is what will happen. Statistically, this is what will happen. It's like if I said to you, toss a coin 100 times. Statistically, you're going to get about 50 heads, 50 tails. This is exactly the same with the markets. If you don't believe me on any product, any instruments, try it and see what happens. And that's what's going to happen. All right. We've had this research published. We didn't even need to. There's different ways of proving this. All right. So that's one type of trader we're going to remove. We're not going to do this. Okay. We're not going to do it. And you might say, what? Oh, what are you going to do? Are you going to make the targets closer to each other? No, that won't really help. You'll just still find a new way of losing money. Okay, just because you have a tighter stop loss, that's not going to help you in a more modest target. So you might say, I know what you're going to do, Alpesh. You're going to remove the stop loss. No way. Remove the stop loss, and yes, indeed, you'll get about 10 trades which do make money and hit your target, but 90 of them will just keep going sideways or lower, and you'll hold those, you'll turn those trades into investments. Put your hands up if you've done it. You'll put, okay, the answer to your question, Aman, is yes, exactly correct. Yes. Okay, so you'll put money into those trades, and it'll just get stuck there, and you'll run out of money eventually, and then you'll start exiting some of those positions, and you'll have a bigger loss. So the fourth type of loser that we're going to avoid, and why our strategy avoids all of these scenarios so you can understand it better, is this. Okay, you say, oh, well, I know what to do. I've worked it all out. What I've got to do, really simple. I've got to have a really small take profit, and I'll put the stop loss. I'll keep it, but I'll put it further away. No, try that experiment. Try it. You will win a lot, and you'll be so happy. Oh, I'm a winner, Alpesh. But you'll never tell me about your losing trades. You'll keep those on the books, and you'll keep quiet, and you'll say to your spouse, oh, no, don't worry. Those are losers. I'll come around. We've just elongated our time frame horizon, right? You'll come up with all sorts of mental excuses. And by the way, it's because of those mental excuses that was called the mind of a trader, the mind. Because even though it was about lessons in trading strategy, it was called the mind of a trader, because it is those things that will mess you up. Your mind will mess you up. Okay, and you'll just have found a new way. So why is our strategy different? Well, it has to be in the 20-30% who make money. And that strategy has to be different because whether we're going to be worried about inflation or not, or whether gold will rise or oil will or not, or what's happening politically, and President Biden spoke to President Xi yesterday, so the oil markets have stabilized because they think there won't be conflict in the Middle East, or whatever else. We're not going to try and be masters in economics and politics, okay? That's not going to help us make money. What we're going to do every time is going to be the trend following momentum trades I'm talking about. Okay, our stocks overvalued, might the market crash? Should we go into banks, real estate, big cap, big tech, whatever? Will the dollar fall? Won't it? What about the debt? We're not going to try and be a smartass. And by the way, don't get me wrong, I've got a degree in politics and economics from the world's #1 university. I can bore you to death with politics and economics, but it's got nothing to do with trading. It's got nothing to do with trading. Our trading is not that. You might be able to trade that way if you want. I think it's a hard way to earn a living. There's many ways to earn a living, many ways to trade. That's not the way we're going to trade. Okay, we're going to trade in a far more simpler way. And this is actually what we found all the top traders do, the most profitable ones. This is what their profit and loss looks like. It'll look like this. It looks exactly like this. They will, out of 100 trades, they'll have a few big winners. And you might say, why didn't you only have big winners and nothing else? Nobody has cornered the market in crystal balls yet. That's why. Okay, what we, like everybody else, have are some small wins and some small losses. And you might say, well, why did you do the trades, which should be small wins and small losses? We didn't. We only did it when we thought it would be a big win. But somebody does a tweet, somebody takes Kabul airport, and all of a sudden the price moves back and it was only a small win or a small loss. The most important thing is this. How do I remove big losses? And how do I get those big wins? Your profits, write this down, 80% of your profits will come from 20% of your trades. Write that down. 80% of your profits will come from 20% of your trades. My job in this webinar is to remove your big losses. And let me ask you this. If in the last year you took all your trading and we removed your big losses, and we'll define this later, your big losses, would you be profitable? Of course you would. Statistically, you'd have to be. Okay, notice how the small wins and the small losses cancel each other out. They just pay for each other. It's only this. That's where your returns come from. Of course, I would like that to be 100%, but I don't have a crystal ball or a time machine, and neither does George Soros or David Harding or anybody else in the industry, and neither do any of these traders either. I thought they did when I met them and interviewed them. I thought they were going to tell me how they win all the time. Every single one of them said, no. Bill Lipschutz, global head of foreign exchange trading at Salomon Brothers, said, I'm right 40% of the time, Alpesh. And I said, and you're global head of forex trading at Salomon's? He goes, yeah. I'm bloody profitable, right? Don't take my word for it. It's in the book, okay? It's in the interview with him. And he wasn't the only one. Time and time again, it happened. So given that 70% of retail accounts lose money when trading, whether it's spread bets, CFDs, options, or whatever else, is it worth our while? How are we going to turn a profit? Okay, so start with this business process, as I promised in the agenda. Let's start with this sort of simple business plan first, then we'll do a more detailed one. Let's say you do 25 trades per month. In other words, roughly one a day. So we're not going to go crazy, okay? Because believe it or not, banging the keyboard doesn't make you rich. Just banging it more often doesn't make you rich. So let's say you do 25 trades per month, okay? Let's say you lost at most 1% on any one trade. You lost at most 1% on any one trade, okay? 1% of your capital. Now, initially, your capital, like with me when I first started out, might be nothing, next to nothing. Okay, it doesn't matter. It doesn't matter what it is. It's if you can learn to be profitable with small amounts of money, then you'll find friends and family to expand your capital and grow bigger, or you'll put more money from other sources into it. But we're not going to start taking high risk by, with no skill whatsoever, plowing into trading. Okay, what we're going to do first is learn the skills and the plan. So let's say you're losing at most 1% on any one trade, and say out of 25 you have 15 winning, 10 losing. Okay, so it's not quite 50-50, it's a little bit better, and that's my goal, is to put you a bit better than a coin. Coin's 50-50, a bit better than a coin. And let's say you make more money when you win than you lose, so you make 2% on your winning trades. Just assume these numbers for now. Bit optimistic, but let's just assume them for now. So you have 10 losing trades, each losing 1%. Then you've made 20%, because 2 times 15 is 30, and 1 times 10 is 10, so you've made 20%. Okay, simple as that. If we assume these numbers, they're over optimistic, so we'll cut back on them in a second. So if you have £2,000, then you made 400. That's the maths of it. I know we're being a bit optimistic because it's easy to write that on paper, but in reality it could get more difficult. So let's get a bit more conservative and a bit more pessimistic. Let's say you only did half of that. Well, it's still 200 a month. Like I said, if you can make 200 or you can make 500, you can make double that. If you can make double that, you can make more. And the point is, our problem shouldn't be lack of skill. It should come down to how much capital we've got. Okay, that should be the only thing which we're worried about. Not, oh, I don't know what the hell to do. I don't know when to enter, when to exit. Those things I can remove. When to enter, when to exit, where to put a stop loss, what products to do, what business plan, what strategy. That I can solve in a webinar. Getting capital, that'll be your problem, from whether it's your savings or friends, family, or whatever else. And you'll only ever use risk capital, remember, with trading. That's the law. Okay, well, that still comes to 100% per annum. That's not my number. You might say, well, it's all very well you saying 100% per annum. Who the hell are you to say 100% per annum? Actually, it wasn't me. Bill Lipschutz, in print, in my book, he said it. He said a private investor should be doing about 100% in a year. And I thought, well, if that was the case, how come they're not all billionaires? He goes, they won't have enough capital to block the markets and keep growing at that rate. It's as a private investor. Okay, John, no worries at all, my friend. Okay, so how are we going to solve the problem of the fact that we know algo trading dominates the markets, and we know there's bizarre stock moves? The reason there are bizarre stock moves is because of the algo trading, which is momentum. It is this. It is, there's the green arrow, okay, for buying. There's the arrow for, that's for selling. That's the direction we're trading in. A private investor makes 500, okay? A wealthy trader makes 5,000. What's the difference between them? They've got the same information, the same buy and sell decisions. It's how much capital they've got. That's the only difference we want to keep. We're going to make sure, whether it's an algorithm that's moving the markets, or we don't even understand why 1 minute it's going up and 1 minute it's going down, we're just riding the trends and the momentum. So we need to find that. I need to ask your quick permission. Like I said, right in the last 10 minutes, I'm going to tell you what my hedge funds plans are. And the reason I give this permission, you don't have to stay to that bit. The reason I give that permission is, ask that permission, is otherwise people say, hey, you talked about yourself at the end and you ruined our lives. Some people are triggered very easily. So let me know, and I will, in the last 10 minutes, just continue with that. Now, let's get back to the webinar. Okay. Mahmood, futures markets, yes, absolutely. I don't care what I trade in. So I don't care whether it's NASDAQ. I don't care if it's, like I said, because it's a product, they're prices. I'm buying one thing, selling another. It's like being at a fruit stall. Oh, Alpesh, do you sell oranges? Yeah. Do you sell apples? Yeah. Do you sell pineapples? Yeah. Do you sell pears? Yeah. Because guess what? For all of those products, you're still given cash, aren't you? In dollars or sterling or whatever it is. That's what's important. So let's try this bit. Surely if you can grab 100, you can grab 1,000. This is the essence of what we're trying to do. Okay, if I simplify, it is this. It is know when to get in and when to get out. And our little X marks the cross. Okay, and I'll explain what this yellow line is and what these red dotted lines are. But that's the essence of what we're doing. So what we did over the years, and trust me, 15 years ago when we set up the fund, I'm glad I found the documents. We set up the fund. We didn't have the technology to simplify it this much. We do now, thankfully. We have 10 strategies, and the one that I'm talking about is the first and earliest one, which I got from the leading traders. So I just want you to know. It's only the one strategy I'm talking about here, which I think is the easiest one for private investors to do, because that's what I was taught and did. Now, you might say, well, why are you telling us any of this? I'm not the first. I won't be the last. We don't have a problem sharing strategies. If you want trading strategies, go to Oxford University Maths Department. You've got a bunch of people who will give you trading strategies. The scarce resource is not trading strategies, or people not telling you, or hedge fund managers not telling you. We've got to tell every investor we come across what the strategy is. Otherwise, they're not going to give you money on the basis of, oh, Alpesh, you're rather handsome young man. Let me give they're lying on two fronts there. Let me give you some capital. No, you got to describe it. The scarce resource is capital. It's not strategies. Okay, it's not scarce resource in the world is not clever people, right? It's money. Okay, it's always been the case, right? So why are we doing this? Why are we doing trend following or momentum trading? So again, before I explain the strategy, I want you to understand, because it's my livelihood, the whole thing that I've been doing from the hedge fund to now, I want you to understand and respect why we do momentum trading. These are hedge fund managers, every single one of them. Okay, they all do the same strategy, which is their trend following. John W. Henry owns Liverpool Football Club. David Harding is also a favorite of mine. He's British, and Man Group. And tell me which parts of the world you're all from, please. Okay, is it your tactic working for day trader? No, not a day trader. Okay, so why trend following? Well, we know it's been proven in the industry. And what the hell is it? Well, this is a slide from Winton Capital, which is based out in Hammersmith in West London. It's a $350 billion hedge fund, and that's a slide taken from one of their presentations when they're explaining what they do, and that's what they do. They buy when the trend starts. They can't see it. Okay, nobody can. Nobody's bottom fishing. They don't buy before. They don't buy in a falling market. They're not anticipating the market. They're not gambling on which way the future might go for NASDAQ or S&P or oil. They don't care what any of those instruments are. They wait until there's been a move up. Therefore, there's a lag necessarily. Because, there's a lagging indicator. Honestly, the rubbish you see on the internet. This is what billion-dollar hedge funds do. They welcome the lag because it gives them greater confirmation of a move up. They're not scared of a lag. They're not trying to catch bottoms. Anybody who goes, oh, I've got a special technique of pinching bottoms and hitting tops. Absolute nonsense. So this is what they do. Now, how they try and get that, and everyone else sees the same prices, how they get that is going to vary from how I might find it. We're both looking for the same thing. They're going to have different formulas to what I do. Mine are going to be a lot simpler, so I'm not going to be able to get as many trades as them or handle as many, but it'll be enough, as I'm going to show you, okay? And that's the essence of what we're doing. How did I learn all of this? Well, Bill Lipschutz, like I said, that's him, global head of Forex at Salomon Brothers when his chairman was Warren Buffett. I never met Warren, but I did meet Bill. And Bill was interviewed for that and 9 others. And it's thanks to him that I have the strategy. It's thanks to him I have the hedge fund, because if he didn't teach me all, well, him and the 9 others, I wouldn't know any of this, okay? And this is in essence what he said. You're riding coattails. You're that guy. You're not, if that guy in the bowler hat is Goldman Sachs, who are moving the markets, you're not moving the markets. You're also not trying to guess which way they're going to go. The markets are going to go. You're that guy. You're going to ride the trend in whichever direction they go. Now, I like that because, clever as I think I am, right, I don't think I can predict the market every single minute of every single blasted day. Okay, I just don't, right? Because I don't think intelligence is going to be the answer to be able to predict the markets. I'd rather ride and I think that is interesting. I'd rather ride the trend. Let me show you. So the Amazon one. Let's look at Amazon. Now, those of you who follow me will know I'm a fan of Amazon and I'm long on Amazon. So when I'm trading, okay, that's a short trade. Didn't work out. That long one worked out nicely for a short time. And the advantage of being in the market for a short period of time is, should it ever crash, hey, guess what? You can get out quickly. So that worked. That didn't work. That worked, okay, a little bit. And then that one's short. Now, I tell you why I like shorts. I like shorts in Amazon because I've got a long-term long position. So every time I profit from it falling, I'm sort of hedging my long-term long position, but I can use those profits to buy more Amazon stock at a lower price for the long term if I wish. Okay, that's why I wanted to just show you how trading and investing can go hand in hand and one feed off the other, and trading be the icing on the cake to your investments. Okay, so that's the essence of the strategy. So what does the strategy involve? Right, I want you to take a picture and write it down. It says it there, write it down. Okay, write down Selma. This is what it stands for, by the way, what Selma stands for. Stops, entries, limit or take profit. We're not going to do that. Well, I'm going to show you when you do it as a beginner. Money management, how much money you put in. So I'll show you that in the business plan. Trading psychology or mind, and adding to winners. And I want you to write this down. Winners add to winners, losers add to losers. Now, imagine you had this. Didn't go anywhere, and then you have this, which makes you your fortune. All right? Now, let me tell you what's happening. So what are the key elements of any trading strategy? It is SELMA, which means that's your stop, yellow line. Why is that stop there? What I learned from the world's leading traders and what we copied was they all used VSL, volatility-based stop losses, okay, and VPS, which I'll come to in a second. So what's volatility-based stop loss? All it means is you put a stop loss further away if the market's more volatile, which is genius, because if the market's more volatile, of course you want your stop loss further away. You don't want to be whipsawed out by noise. So how do you decide it? In a way, it might be through eye, it could be through experience, or it could be through mathematical routes such as 2.5 times average true range. You can look up what average true range is elsewhere. Doesn't really matter as long as it's not too close and it's not too far. It's the principle that's more important. So we tend to use a percentage of average true range. You know, could be better. It's fine, gets the job done. I'd rather be earning the money than trying to be an academic and work out to the 10th decimal point what it should be. Okay, so it does the job. Volatility-based stop loss. That was the first most important thing we learned. The next thing we learned is, well, wait a minute, if the stop loss is further away because the market's more volatile, surely I'll lose more money if it gets hit. So volatility-based position sizing, or VPS, means smaller position size if the stop loss is further away. So whether the stop loss is here because the market's not very volatile or miles away because it's more volatile, you still risk losing the same amount of money. That's how you decide how much money to put in. So that takes care of M as well. Because you've got a set of rules and a process, which we're going to go through, it'll take care of money management. It'll take care of trading psychology or mind as well. Now, I've run through that relatively quickly. The distance from here to here, to the yellow line, let me just clear this and make things a bit easier. That distance is the same as this distance. So what is this red dotted line? That's the point at which you add to your winning position. Write that down. Winners add to winners. What we discovered is most successful traders were adding to their winning positions. Losers add to losers. So you never move your stop loss lower and you never add to your losing position. That's in trading. In investing, you might. Look, if Amazon, you're buying it for the next 12 months and it drops 20% tomorrow and there's no reason for it to have done so, you might buy some more, but that's not trading. That's investing. That's different. We're talking about trading, okay? So those were two other best practices, not just of our hedge fund, but others as well. And these are the things we have to explain to investors, because when investors say to us, well, why should we give you 10 million? We've got to explain, well, this is how we protect our downside. This is how we're doing it. Now, still leaves this, E, entry. Okay, I've still got to discuss entries with you. So let me discuss entries with you, which is the key part of the strategy and the business plan element as well. So let's get on with those bits. Okay, if you're a beginner on this, now, all trading is ABCD. ABCD. D is some of those few losing trades. What can you do? There are few losing trades. It's going to happen. But with a good momentum strategy, which I'm going to show you and give you, losses should be small in size, short in duration. Point A is your entry, which we discussed. Now, B, I've already said, is your stop loss. C is where you add to your winners. All very simple, yeah? And by the way, you're not a screen slave at doing this. You just put the orders in with the broker, okay, ahead of time. And you can calculate when you've got the entry, you calculate what the stop loss is. Simple. You tell them this is where the stop loss is. Now, what I want you to do, and this is what we tell beginners to do, is you have a fixed stop and a fixed take profit. Why? Well, you're a beginner. You're learning. Okay. So your fixed stop is at B and your fixed take profit or limit order is at C. Simple. Because you're learning. Once you're intermediate, you do a trailing stop, but it's stepped. In other words, when the price goes from A to C, you move it from B to A. Why? Because it gives more room for the markets to move up and down before they go up. Okay. An advanced trailing stop plus you're adding to winners. Right? That's what it is. Why do we add to winners? Well, because it means we can start with a smaller position, because if it were to fall and we can't see the future, then at least we don't lose more money. That's why. Okay. But if it goes in our direction, then we've got some profits in our pocket, which we risk by adding a new position with its stop loss at point A. So we add a new position at C with its stop loss at point A. Why? Because it allows us to risk profits, not our capital, in order to make even more profits. We'd far rather risk our profits to make more profits than our capital, okay? Because everything's about protecting the downside. It's always protecting the downside. Now, Andy's asked, how much do you add to winners? Same as the entry. You can skyscraper, which means same as the original entry, or you can pyramid, which means less. I wouldn't inverse pyramid, which is double your original entry, because you really are taking too much risk then. In fact, I've never heard anybody do that. So pyramid or skyscraper, I made those terms. Now, I know why you're all here. You're all here for this bit. Okay, I don't know who SpreadX are, by the way. I don't use them. I'm not recommending or endorsing them. But I'm saying this was data we found from them all the way back in July 2012 when the Olympics were about to start. And you know, they were talking about all this and how much people make with them and blah, 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 blah. And I could care less about these. These aren't our figures. We want to try and do 500 a month. So don't read numbers like this on the internet and think, you know what, darling, I think I've got a way. Let's mortgage the house and try and go for $1 million in the next year. Please don't. This is an advertising gimmick that brokers like this put out there to get you to trade with larger sums when you're inexperienced so they can wipe out your profits, because brokers now are like casinos. In other words, they're the house. They get the share of the profits. They're not like estate agents matching buyers and sellers, which is what used to happen. They decided that they'll become like the casino or the house on the other side of the trade and take your losses as their profits, because it's more profitable to be a casino than an estate agent. Don't believe me? Go ask a casino owner and go ask an estate agent, which is more profitable. All right. These are the key numbers I want you to remember. 15 minutes, we're going to scan the markets, 12 to 20 instruments, one screen, one trade a day, 20 trades a month. I'm going to show you the business plan before I give you the entry bit of the strategy, because the entry bit's the last bit of the puzzle. How do you know when to enter in a second? Okay, scan for 15 minutes a day. Why not longer, Alpesh? Surely the more we hit the keyboard, the more money we make. It doesn't work like that. If it did, I'd have an automatic finger just tapping my entry key every second. It doesn't work like that. Also, because what we discovered is 20 trades per month means you'll focus more on quality. When people were in front of the computer for longer, our research published in the FT shows that they did more lower quality trades. And if they were losing, they did more losing trades out of frustration to try and make up their losses. And if they were winning, they did losing trades out of greed, ego. Okay, that's why I don't want you in front of the screen too often. Yes, we get signals which can be sent to us, but I don't like that. I don't like it because it leads to market chasing. Okay, all those psychological problems it leads to. It's far better to be in front of the screen 15 minutes, pick your one trade of the day, or batch it on Fridays, on Fridays. Markets are open 24 hours a day, 6 days a week. So whether you're in Essex or whether you are in Australia, it won't actually matter, okay? Because the markets are open 24 hours a day, 6 days a week. And the other point I want to reinforce again, if you're waiting to be right 80% of the time, you will never make it as a trader, as Bill Lipschutz said. Now, I'm going to get to the really important bits, the business plan in more detail and the entry strategy, which is the most important bit. I want to share this other data with you. Please take a picture of this. Okay, this is from a brokerage. What they found is the percentage of profitable traders grouped by average trading equity. So if you've got more than $10,000, okay, you're more likely to be profitable. Why? Because the percentage of money you put in is still going to be relatively small to that 10,000, and you're less likely to be wiped out. Whereas if you only got $1,000 to $5,000, you're more likely to be wiped out because the amount of money you'll put on an individual trade will be a bigger proportion of your capital, and therefore, let's say you get a losing streak, you throw tails 3 times in a row, you're going to be wiped out. Okay, so that's interesting, because that's not got to do with the fact that people with less capital are stupid or people with less capital have bad strategies. The only variable here is account size to profitability. Why? Because it's to do with money management. So my point to you is this: I don't care whether you got 1,000, 1,000, 5,000, or 10,000. We're going to make sure we have a proportionately smaller amount invested. Now, I want you to start with 0, okay? Because once you learn the skills, then you can worry about having 10,000 and improving your profitability. Okay, learn the skill first. Also, I want you to look at this data, take a picture. Retail clients again. You'll notice with some currencies, they do a bit better. They never have an average gain overall over average losses, but they do better. The currencies that I like, write it down, are major versus minor or minor versus minor currency trades. Now, I don't care whether it's NASDAQ or currencies, remember. It's all the bloody same, whether it's CFD, spread bets, futures, doesn't matter. It's all the same. It's buy low, sell high, or sell high, buy low. So on that, I prefer major versus minor currencies or minor versus minor currencies. And if you don't know which are major currencies, there's 4: sterling, US dollar, Japanese yen, euro. Okay, everything else is minor. So I prefer major versus minor and minor versus minor. Why? Well, not just because of the data here, but also because other data suggests it's a bit easier to find trends. Why? Well, guess what? The big banks are not fighting over sterling against Australian dollar. There's not much interest. So the trends tend to be easier to get as a general rule. Take a picture of this. I won't go through it now. It's what hours of the day they discovered trader profitability. So you can see it's not all about some secret source strategy. It's about the time of the day you're trading. It's about how much capital is in your account, not just the strategy. Okay, so this will give us an extra edge as well. It's stuff like that I like to share with my students as well to help give an edge. If most traders would learn to sit on their hands 50% of the time, they'd make a lot more money. That's why we're only going to do 1 trade a day. Okay, that's him telling us. So let's go through the business plan. Is it all worth it? And then we're going to go through, the strategy, and then we can do Q&A and everything else. So that's my mum. always makes, like I said, honourable visit in all my webinars. There she is. I don't know why Prince Charles is bowing down to me. We'll have to ask him. Okay, so what are the things that we're going to cover in the business plan and the strategy? There are these. Strategy that works, in other words, something which actually does bloody well pick up a trend. Okay, that goes without saying. So we're going to get the entry right now. Okay, that's what we're going to do. It's got to be simple. There's no point telling you, oh, you know what you got to do? You do an alleyway at the end, then a Fibonacci up there, and then you draw this, and then you do that, and then you do that, and then you do a dance, and you see if it's a full moon, and then you got to enter on the third bar on the 6th minute of each other hour, right? Which is what most people want to try and teach you because they want to sell you some expensive software, right? Nonsense. It's got to be simpler than that. Otherwise, why bother? Listen, if it's not simpler than that, go get a job at McDonald's, right? Why bother? Why bother doing any of it? You won't get the fulfillment or the fun. Remember the 3 Fs I said at the start. Why bother? Stop loss, I've already discussed. Volatility-based, stop loss, volatility-based, position sizing. Got to be able to capture the big moves, which is what our strategy does, and keep the losses small. So just as a recap. And now this bit's really important. You've got to be able to trade easily, which means all you need from a broker, I can recommend various brokers if you want at the end, but there's a whole, basically the answer is, are they FCA regulated? That's the answer, okay? Buy, sell, quantity, stop. That's it. All the other bits that brokers try and sell you on, oh yes, oh, look what you can do. You could be a real trader, man. And here's some really nice software we've created. It'll give you an inside edge. It's a marketing gimmick. That comes out of their marketing spend, okay? All that bullshit. So all you need to be able to do is that. And if you really want to, then you should be able to do it on your phone at any point. It's got to be that simple because we're looking at when to buy, when to sell at the start of a trend. And then we need a roadmap for returns risk. I do not know why I've got a picture of my wife with the words return versus risk. She's going to kill me. But anyway, there's got to be a clear roadmap for returns versus risk, which is the business plan, which I'm going to do. And it's got to suit you whether you've got a day job. And I suggest you continue being a day job and not a day trader. Okay, continue your day job, whatever it might be. All right, my day job is I run a hedge fund. It's not sitting in front of a computer. I can get any numpty to sit in front of a computer. My job as a CEO of the fund is to deal with compliance issues, if there are any, and also to raise capital. 90% of the time, it's just raising capital. It's having meetings with pension funds and high net worths and family offices on raising capital, right? So I've got a day job, and it isn't sitting in front of a screen. It isn't being a day trader. It's as simple as that. So how much money can you make? Let's do the last 2 bits of the webinar. How much money can you make? Is it worth it? And secondly, the entry strategy bit. Now that you appreciate why the entry strategy is going to be the way I'm going to describe it, why it's important that way, so then you know, okay, I see, that's why I've got to have it this way. That's what saves time. That's what solves all the problems of confusion and not being a screen slave. Now, trading is like driving, as Bill Lipschitz told me. He said, look, you got a rear view mirror, you got a steering wheel, you've got a wing mirror, all the rest, accelerator, clutch. With trading, yeah, you got entry, stop loss, volatility-based stop loss, volatility-based position sizing. But you learned to drive, didn't you? Right? I hope you all learned to drive. You learned to drive, you can learn to trade. The rule of thumb I give is, depending on how many hours it took you to learn to drive, that's probably how many hours it's going to take you to learn the essence of trading. And then it's just a question of practicing to improve. The same, because guess what? A human's ability to learn a skill tends to be roughly the same. Obviously, it depends on the nature of the skill, but driving and trading is similar to me. It's not driving in rocket science or brain surgery. Okay, it's going to take the same amount of time, roughly, when the 2 skills are comparable. And I think driving and trading are comparable, okay, in complexity. Right? They're not simple. They're not idiot-proof. They're comparable, I think. Okay, and therefore it's going to take the same number of hours to get on top of it. Then, of course, getting better at it, hey, that might take you a whole lifetime. Somebody hit my car yesterday and blamed me for having parked it outside my house, believe it or not. So some people are, just never going to improve at trading, at driving. They might even get worse. Maximum loss. So this is what Bill gave me as a business plan. When I was at university, I had no silver spoon, no money in my pocket, basically. And he said to me, look, you got to decide whether you want to do this for the rest of your life or not, or on the side or not. And I was training to be a barrister at the time, but I loved trading. That's why I met him and the other 9 interviewees. He said, imagine you've got 1% of your capital. That's going to be your max loss. That's what he started off as a rule. And he said, imagine you got £20,000. I said, Bill, I'd have £20,000. That'd be amazing if I had 20,000. I was at university, all right? And he said, no. It's a business plan. It's about where you're going to be in the future. If the business plan works out and you're starting with a smaller amount, you'll get more capital from friends and family. And he was exactly right, by the way. Okay, so imagine you've got £20,000 to decide whether you want to do this and go down this road or not, right? Maximum loss per trade would be £200, 1% of £20,000 on any one trade. Your stop loss, the amount of money you put on a trade is such that if your stop loss is hit, you only lose £200. He said, imagine you're a bit better than a coin. Just assume these numbers for a moment. We're going to really downgrade them and make them pessimistic in a second. So you win a bit better than a coin. You have 60% winning trades, 40% losing trades, 60% win and 40% lose. So when you lose £200. When you win, remember, you're adding to winners. You're going to have a strategy where you make more money when you win than you lose when you lose. So guess what's going to happen? What's going to happen is this. You're going to have average win £300 instead, okay? Otherwise, we won't do the strategy. So let's say you do 100 trades. And I'm sitting there with Bill. I was at university, as I said at the time, and I'm going through the numbers. And I'm going, oh, okay, this is interesting. And then this number comes up. 60 times £300 equals profits of £18,000. Now, I'm at university. I'm in my early 20s. And I'm thinking to myself, whoa, that's more money than I've ever seen. Bill, call my parents, tell them I'm leaving university. That's the thought that went through my head. And he calmed me down. He said, you've forgotten the fact that you're going to have 40% losing trades. I said, yeah, but Bill, look at that number. This is when I was going nuts. And I knew what my rest of my life was going to be spent doing. I said, hang on, net profits is £10,000 per 100 trades. And then he really got annoyed with me because I did this. I said, that means if I'm a day trader, I could do, because that was the vogue back in the 90s, which is when we did this, 100 trades per week, 50 weeks a year. Okay, because the other 2 weeks I'll just take off and spend my money. 5,000 trades per annum at £10,000 per 100 trades. That means I'll be making £500,000 a year, Bill. Woo, that's money I was saying. Call my parents, call my parents. And he said, don't be stupid, Albert. Just calm down. He said, keep your day job. I said, well, what should I do? He says, well, let's just look some reasonable numbers instead. Let's say you keep your day job instead because you discover you're suddenly not a day trader just because you went to one webinar or you spoke to Bill, right? So you do 100 trades every 6 months, which is one a day. It's one a day, like I said earlier on. There's the business plan with why we should do one a day or 5 a week, okay? That's 200 trades per annum, which is £10,000 per 100 trade. That's £20,000 per annum. So we're not going to do, and you should rightly say, don't be stupid. We're not going to do $500,000. We're not going to do 90%, 3/4, a half, or a third, or a fifth of that. No, let's say we did 10% of that. That's too much, right? Because 10% of $500,000 is still way more than the 500 to 1,000. Let's say even 1,000 per month we want to target, okay? So we took 10% and we said, no, we're not going to do 10% of the business plan. Let's say we did less than half of that 10%. So let's say we did about 4% of the business plan. No, that's still almost double the 1,000 per month we're after. So we look at this and we think to ourselves, hang on, I've got a business plan and I only really need to hit about 2% of it to hit my target. That's a good business plan. That's one worth where I'm thinking, oh, I want to take this to the next level. And you should be asking me at this point the same thing I asked Bill. Well, hang on, if these numbers are right and I only need to hit a small percentage of my business plan, how come everybody isn't rich trading? And he said there were 3 reasons. And I did ask him, and he said there were 3 reasons. Bad teachers, bad mentors, bad strategies. So let's, in the final part of the webinar, look at the entry strategy, because I've looked at the stop-loss strategy and the money management strategy and trading psychology, which is having a process, adding to winners, all of the other parts of the Selma strategy. Let's just look at the entry, the final part of the strategy that's left. My mum again. And remember, 100 trades per 6 months, 200 trades per annum, £20,000 per annum. No, that's not right. That's not what we're after. What we're actually after, remember, don't forget, is 1K per month or 500 per month. And the way we're doing it, as Bill reiterated, was we're riding coattails on momentum. So I said, how am I going to find momentum? I'm a poor student. I can't afford expensive Bloomberg terminals and the like because I was a student at the time. And he said to me, what you'll have to do is use the same 3 techniques all hedge funds do, which is you won't just look for one particular method or indicator. You'll look at multiple indicators, but not the way the textbooks do. And you'll have to use ones which are freely available. None of the ones which are freely available, by the way, work. They used to work in the 1960s and 70s. Then everybody started doing them and they don't work. So what he said is you're going to have to use multiple indicators, because then you should remove the number of false positives. Where when I say an indicator doesn't work, what it means, it gives it false positive. In other words, it says to you to buy, but actually leads to a losing trade too often, right? That's what a false positive is. How do we remove false positives? You don't just have one indication. Let's say you got a heart murmur. You don't just go to one doctor. You might get a second opinion, or you might use not just a stethoscope. You might use an ECG. as well, and take a pulse as well. Those are multiple indicators to try and find a condition. That's the same with trading. We're going to use multiple indicators, but not the way the textbooks do, because if textbooks could do it, then that's all we need. But the reason we had to do that is because we didn't have money to have some kind of clever new, rocket scientist come up with a new strategy for us. Okay. And he said, the second thing you'll do, which all hedge funds do, is use multiple time frames. So you won't just look to see, are you seeing a trend in this time frame? You'll look to see in the next time frame. And and I'll show you all of this now in an example, or in multiple examples. You'll also use PC and PR, and I'll come to what PC PR is in just 1 second. So I said, how am I going to measure the momentum? And why do I want to measure strength and momentum? He said, look, what I want you to measure is how close to the high is the price closing in any one period. I said, why? He goes, well, that'll suggest there's momentum and a trend, because if the price is closing near the high, that means there's lots of buying pressure. It's a bit like those TVs, auctions you see on TV. I got 40, anybody give me 50. I got 50, anybody give me 60. I got 60, anybody give me 70. I got 70, anybody give me 80. That's momentum. So if the price is closing near the high, it should mean probably it will move higher the next period. Not a certainty, but he said, we don't just want to use one indication of momentum, which is that. We also want to look to see, is it making higher lows and higher highs, i.e. multiple indicators to avoid false positives, because no one indicator that we're going to use ever works. Okay, combine that into one super indicator, as it were. And not just that, but across multiple time frames. So look in the next time frame and see, are you seeing higher highs, close near the high, and high lows? And I said to him, well, how am I going to do this? What, with a magnifying glass, go through all of this? I'll be a screen slave looking at every single chart. He said, no. Use the indicators which are freely available, but just use them slightly differently. So he said, feel free to use MACD, even though it doesn't work. It gives too many false positives, but combine it with other indicators, which are also looking for the same thing, higher lows, higher highs, and so on. So combine it with, say, stochastic and momentum. If you don't know what those are, they're freely available, these indicators, but use it a way the textbooks aren't. Okay, so multiple indicators have to all show that they're flat to rising. Flat to rising. What do I mean by flat to rising? And why are we looking at flat to rising? Well, and look, they're widely available. There you go. Yeah, just moved it across, right? It's got to be flat to rising before we look to get in, but not just that one indicator, all the other indicators. So until then, you don't get in. That's why we got in a bit later than we would have done if we just looked at one indicator. And flat to rising in MACD, stochastic, and in the next time frame along. And I said, oh my God, that's a lot of stuff. And he said, no, because once you put it into a computer like that, hey, that's done for you. Then you're just scrolling across, okay? And it doesn't matter what the formula is and that it's that complicated. It doesn't matter at all. What matters is this is all you're doing. You're looking to see, is the price closing near a high, higher lows, higher highs? That's MACD, stochastic, RSI. It doesn't matter that those don't in and of themselves work and they give too many false positives. By the time you use them the way the textbooks don't across multiple timeframes and make sure the multiple indicators are all ticking in the right way, you're closer to the end result. The end result being, remember, it wasn't just multiple indicators, multiple timeframes, it was also something else, PC and PR. Just look at multiple indicators will not make you enough money. Well, it won't make you anything, you'll still be losing. Just looking at multiple indicators and multiple timeframes will still make you a losing trader. Just looking at flat to rising indicator, right, which on flat to rising, I mean that bit, won't make you enough money. You also needed price confirmation, which is PC, the third thing, because otherwise you'll just be the cleverest person in the room, right? Until Goldman's or whoever else pushes the price to a 2-period high, whether it's the 15-minute bars you're looking at, 30-minute, and my preferential time frame is 15, 30, and 1 hour, and I'll tell you why, because I think it's the most optimal for making money. What happens is you haven't got price confirmation. If you haven't got price confirmation, you're not likely to be profitable. So that third thing is the most important, price confirmation. PR is pattern recognition. You don't need to worry about it. We use Microsoft Azure's AI technology to keep a library of patterns which correlate to subsequent moves. You don't need to worry about it. It's more icing on the cake for us. It's not something you're going to be able to do, so don't worry about it. Okay, it's enough that you've got multiple indicators, multiple timeframes, price confirmation, and that's an example of that. Okay, that's an example. When that runs out, our systems will tell us the X, but you can do that manually. So all of this, I've given you the manual rules. If you want to do it automatically, I'll show you how to download it in a second, but the manual rules you have. And what we found when we were explaining this is a talk I gave at Bloomberg, is this was something everybody could understand. And of course they could. They can understand momentum. They can understand prices going, making higher highs, and then the trend following. They can understand why you'd use multiple indicators and not just one to avoid false positives. It's like filtering water. If you go through 3 filters, i.e. 3 indicators, the water's going to be purer. The trade's more likely to be right, i.e. it's a purer trade. Of course, that all makes sense. You know, everybody can understand that. And that's why it made sense. And these are some of the people who come to my talks for that reason, because you can simplify. And if you couldn't simplify, you shouldn't be doing it anyway. So I'll show you how to download it if you want in a second. It's something which my hedge fund spun out as technology, and our plans are to float it on the stock market, but that's a separate issue. So I've given you all those bits. I used that, I perfected it when I was at university. That's what I looked like when I met Bill. I mean, I wasn't wearing those clothes. That's my last exam, hence red carnation. Used it to win awards in the FT. It's me on the front page of the business section of the FT. They then offered me my own column when I won that competition, and I said, hell yeah. And they said, would you like to write books on your trading because you're good? And I said, yeah, because I want to raise my profile. If you win a competition, you want to raise your profile. I had a show on Bloomberg as well. Why do you want to raise your profile? So you can raise capital for your hedge fund. Without profile, you can't raise anything. Okay, so that's what we did. Now I want to use the same profile for our fintech, our financial technology out of our hedge fund, because we think there's a massive market in using this kind of profile to solve the problems I've discussed that private investors have, which is that they don't know when to enter, when to exit in a professional manner. And so we sort of give them the ability to do it. And whenever I'm on the news or Bloomberg or whatever, talking about the market, it's this indicator, it's everything that I've told you that I'm using to determine which way I think the markets are going. It's as simple as that, okay? So yeah, they then offered me that. These guys, Merrill Lynch, HSBC, used the research. We licensed it to them and a few others. And in total, we were paid $1 million, which helped me set up the hedge fund. There you go. That's me in, well, 2007 when Simmons wrote that letter. And as you can see, that's not the Cayman Islands I was in. It was in 11 Waterloo House in London. So I found that today when I was going through some old university documents, funnily enough. Okay. Then people said to me, well, wait a minute. This is amazing. So a guy at Barclays Bank said, why don't you spin this technology out? After all, what you've got is something which people can learn at their own pace with one-to-one attention from you. And I said, I don't have the time for one-to-one attention for people. And he said, no, there's a way of doing it where they get one-to-one attention. Convenient for them, compatible with their work. There's no hotel and travel costs, which with COVID you don't want to do anyway. They get live trading practice and you can look over their shoulder, which I'll show you in a second. Ongoing support for life. And I said, well, I don't want to do this. I don't have the time for it. And he said, yeah, but look at all these numpties. You could have a global market of people and a multi-million-pound technology business, which you could float. And we at Barclays will float it for you if you want. And that's when I started getting interested. And I said, what kind of numbers? And he ran the numbers. He said, well, it could be $1 billion float eventually. So I loved that idea, of course. And so it was his idea to convert the technology. And I said, well, it's got to have certain principles. One, I don't want to charge people for data. I don't want to charge people for the charts and stuff that you've seen. I don't want to charge people for anything every day, every week, every month. I don't want to do that. I don't want subscription because then I'm taking money out of their pockets. I've got a conflict of interest. I want them to then drag out using me as opposed to learning, getting the hell out there, use the software, get the hell out there and make money. Okay. Don't worry about that. Without an indicator, this is what, so he sent me this slide. So he was trying to convince me and he sent me this image, actually, not a slide. He sent me this image and he said, look, without an indicator, that's what people are doing. They're sort of picking one trade at a time and it's pretty hard work. You can make money. That kid's a bit fat. He's, doing all right. But that's not the same as the guy who's running the bloody combine harvester. Okay. He's doing a lot better. He's mechanized. And so he said, look, you got to automate and mechanize all the workflow. And that's what, in a way, the indicator that we created, the software we created, did. You can do it manually, which is what I've taught you, but sooner or later, what I suggest you all look at and do is have those rules automated for you. Multiple indicators, multiple time frames, flat to rising, volatility-based stop loss, volatility-based position sizing, where to add to winners, and then we put that up there for when we're training our staff in the office, and we tell the staff, follow the rules that we've just taught you, okay, for that reason. And what we found is that when people had the indicator, so before it and after, their confidence in the strategy went up. They had lower stress over losses because they knew the losses would be limited, small in size, short in duration. A business plan for long-term profits because we gave them the business plan. They had clarity of exits, clarity of entries, clarity of stop losses. What more do you want? So Bhikkhu from Barclays, this was his idea. Project Pips Predator, we called it. Okay, well, he called it, and it was his idea. Buy when the price goes above the horizontal line, because that confirms price momentum, multiple indicators, multiple time frames, and so on, and that alerts you. And the great thing was, I then said to him, well, wait a minute, what if people say, oh, I want to do NASDAQ, I want to do oil, I want to do this, because I mainly do Forex. And he said, it doesn't matter, because they can do it on anything, because it's a trend. Trends are around. I said, actually, you're right. It doesn't matter. They can fixate on whatever they want. And as time went by, he had a great idea when Telegram launched. He said, well, why don't you actually tell them which ones you're looking at every day as well? So I do that on Telegram on a private channel for my Pips Predator users on there as well. And we found, by the way, we found the most profitable time frame is this. I'll show you how to download it if you wish. Was that one, the 1 hour time frame. Now, it doesn't mean we don't do 30-minute and 15-minute. I like those as well. But the reason the 1 hour time frame worked out to be the most profitable is this. What we had in any given time, okay, and I'll show you some more of the trades and positions in a second and how we're doing on them. By the way, the S&P, we are long at the moment, the S&P. Not long with much confidence, but we're long the S&P. So if you want to look at that at the moment, and that might, yeah, we'll see what happens. Okay, that's a 1 hour one. It's this, the net pips captured in a month were 2,250. Now, some months you might get as high as 4,000. Other months, because the markets are particularly active, other months you might get as low as 0. Remember, some months you do more, some months you make less, and you iron that out, you average it out, and that's what you're targeting, say 500 to 1,000 a month. That's how it works. It's not a bank account, which is guaranteed. The market's not guaranteed. And that's 1 trade per day or 5 a week. But you might do more, you might do 40, or you might do less. If it's a quiet, rubbishy month, you might do 17, for instance. So there's variance in those numbers. Okay. Now, here's what I want to tell you. Let's say you did $2 a pip or a point or a unit. Doesn't matter what you call it. Okay. And if your stop loss is typically 50 points away, which is what oftentimes it is, you're losing $100. That's too much. But so don't trust anybody who ever says to you, do $2 or £3 or even £1 is too much. And I said to my team, hang on, that's too much. They said, wait a minute. Let's say you did $2 a point and you average 2,250 in a month. Well, that means you've made 4,500 in a month. And I said, yeah, but wait a minute. We're only looking to do 500 a month. So we can do 10% of that, which means we can do 10% of that, which means we can do 20 cents. Now, no software provider, no broker, nobody out there wants you to do 20 cents a point. The brokers allow you to, but they don't want you to. You know why? Because they can't rip you off. They can't take your money off you too quickly. But if you did 20 cents, then, and you get those points, then you're on target for your 500, which is fine. So I knew we then had a retail product. We had a product for the mass market, a bit like the Google of trading, because it was something you could do with a small amount of money where you're risking $10 or £10 on a trade, not 100, right? You could start small. You could start with a demo account. You could start with any broker because it's broker independent. So it removed all those conflicts of interest, which always pissed me off, that people who are trying to, a broker's got a conflict of interest with you because they want you to lose money. The software company saying to you, oh, it's £1 a point that you should do, it's got a conflict of interest because they're trying to shove a brokerage down your throat because they're getting a kickback off them. So they want you to lose money. Okay. So all of that, it removed all of those conflicts. And I thought, we've got the Google of trading, because Google is an algorithm which scours the internet, doesn't it, for information. Well, this is an algorithm which scours the internet for whenever there are multiple indicators. I'll take this one, Ethereum, right? When there are multiple indicators, flat to rising in the market, surely it's the same thing. Or take the FTSE, right? It's an indicator which is telling us short. We're long the FTSE at the moment, so we'll see what happens. Okay. Now, sometimes we get, and this is why we do the one-to-ones with me. Sometimes somebody will message and say, oh, but I'm not happy about holding positions over the weekend. You want to have a bespoke risk appetite to suit your personality. So most of my students will say, no, I don't want to hold positions over the weekend. And I'll say, that's perfectly fine. There's not a right or wrong answer. It's to do with your personal appetite. Your risk appetite is like your food appetite. It's personal. Okay. And what we did is we started mentoring people, teaching them, giving them the software, the Pips Predator indicator, a business plan, practicing and testing, looking over their shoulder, allowing them to look over mine as well, a 12-week training course. But they can do that in a shorter time or for the rest of their lives if they want, and it's updated each week. The Telegram channel's updated daily with which trades I'm looking at, following how they're doing, give them an exam so they can have a certificate at the end for their LinkedIn if they wish, monitor them, and it's for life without any fees. And the reason we don't want to do fees is this. What we wanted to do was get 1,000 people through the program, then go to the venture capitalist at a 30 million valuation, and then 3 years after that, float it as an IPO